In 1986, the United States government realized they were losing, well, basically a multi-billion-dollar game of global hide and seek.
Oh, absolutely losing it.
Yeah, because American investors were legally moving just mountains of cash offshore, and the IRS was structurally powerless to stop it, at least until they wrote Section 1291.
Right.
So today we are looking at excerpts from a document labeled JCS 1087. It details sections 1291 through 1297 of the tax code, which were born out of the Tax Reform Act of 1986.
And, what looks on the surface like this dense, totally dry legislative accounting is actually a blueprint for how the government completely rewired global investing.
Okay, let's unpack this. Our mission today for this deep dive is to figure out the creation of something called a PFC.
The Passive Foreign Investment Company.
Exactly. We need to understand how offshore funds were structurally beating the U.S. tax system and explore the sprawling labyrinth of regulations the government constructed to force a level playing field.
It really is a masterclass in closing loopholes. I mean, we're looking at the exact moment policymakers recognized they were being outsmarted on an international scale.
And they were, right.
Oh, completely. And this document outlines the incredibly intricate traps they engineered to drag that capital back into the light.
So, to grasp the magnitude of what Congress did here, we should probably establish the baseline rules of U.S. taxation. Like, how did it work before 1986?
Right. So the foundational principle, and this is true both back then and today, is that United States citizens and residents are taxed on their worldwide income.
Meaning geographic borders don't protect you.
Exactly. It doesn't matter if you generate revenue in, like, Chicago or London or Tokyo. The U.S. government expects its share.
But the game changes entirely when you introduce corporate structures into the mix, doesn't it?
That is the crux of the issue. The U.S. generally does not tax foreign corporations unless their income is directly tied to business operations physically located inside the United States.
So clever American investors realized they could just take their capital, park it in a foreign company, and have that foreign entity conduct the investing for them.
Precisely. Because the entity itself was foreign, the U.S. couldn't touch those earnings as they grew year after year.
So you get this thing where the investor essentially achieves deferral. You put off paying any U.S. taxes on that growth until you finally decide to bring the money back home.
Right, and usually by taking a dividend or selling your shares.
Yeah.
And given the time value of money, deferring a tax bill for, say, 10 or 20 years allows your principal to compound at a radically faster rate.
Much faster than if you were paying a slice to the IRS every spring.
Exactly. Deferral is the entire engine driving this dynamic. The mathematical advantage of tax-free compounding over decades is just staggering.
And Congress obviously knew this was bleeding the U.S. Treasury dry. I mean, reading the sources, they detail a whole alphabet soup of prior defenses they had built over the decades to stop this capital flight.
Yeah, they tried to build walls. You had the Subpart F rules targeting controlled foreign corporations, or CFCs.
Right.
You had foreign personal holding companies, FPHCs, and you had rules for foreign investment companies, FICs. They were all designed to identify offshore vehicles that existed solely to shield American money.
But reading through the source text, it becomes incredibly obvious why these early walls failed.
They all shared one fatal structural flaw.
Right. Every single one of those anti-deferral rules only kicked in if United States persons owned a majority of the foreign company.
Usually meaning 50% or more of the vote or the total value of the shares. That threshold was the Achilles heel of the entire mid-century tax code.
It's like a VIP club bouncer who is completely strict, checks everyone's ID, pats everyone down, but only does it if exactly half the people in the line arrived on the exact same party bus.
That is a great way to look at it.
Right, because if they arrive in separate cabs and just mingle in the line, the bouncer waves them right through. So if I'm a foreign mutual fund manager trying to attract U.S. money, couldn't I just structure my fund to ensure I sell my shares to a scattered group of global investors?
You absolutely could.
As long as I broadly distribute the ownership so the American Select never, ever hits that 50% mark, I am basically invisible to the IRS.
And the source text confirms this was the primary, highly organized strategy. Foreign investment funds easily avoided being classified as foreign investment companies simply by actively managing their shareholder demographics.
Wow. So they literally just made sure U.S. ownership stayed comfortably below that 50% threshold.
Yep, which means they could openly market the Holy Grail to American investors, which is completely tax-free offshore compounding.
And to make it even worse, when the U.S. investor finally sold their shares, They could often convert what should have been taxed as ordinary income into long-term capital gains, right? Taking advantage of significantly lower tax
It
rates.
is a massive drain on revenue, but it was also structurally destroying the domestic financial industry.
How so?
Well, U.S. mutual funds, legally known as regulated investment companies, or RICs, are required by law to distribute their income currently to their investors. They are physically barred from offering deferral.
Oh, I see. So domestic funds were forced to play by a set of rules that mandated immediate taxation for their clients, while these offshore funds operated in a sanctioned regulatory vacuum.
Exactly.
If you were an investor looking to allocate capital in the early 1980s, the U.S. tax code was essentially bribing you to send your money to the Cayman Islands. It was actively penalizing you for investing in American funds.
What's fascinating here is how explicitly Congress addresses this imbalance in the text. They state a core legislative belief for the 1986 changes, which is that tax rules should not dictate where an investor allocates their capital.
The overarching goal was tax neutrality.
Right. And investment should attract capital because it offers sound economic fundamentals, not because it's wrapped in a tax avoidance vehicle beyond the reach of the IRS.
Okay, so Congress realizes the whole who owns the company test, that 50% bouncer, is a complete failure.
Total failure.
The global financial industry is just walking right past him. They need a completely new mechanism to force tax neutrality.
And they realized they had to abandon ownership thresholds entirely. If tracking the nationality of the shareholders wasn't working, they had to start interrogating what the foreign company was actually doing with its capital.
And that realization birthed the PFIC, the passive foreign investment company.
Exactly. And the defining feature of the PFIC rules is that they apply regardless of the U.S. ownership percentage.
Right. A foreign corporation could be 1% owned by Americans or 99% owned by Americans. The ownership metric is completely removed from the equation.
Instead, Congress created two ruthless mechanical tests. The first is the income test.
Okay.
A foreign corporation is classified as a PFIC if 75% or more of its gross income for the taxable year consists of passive income.
Okay, catching 75% passive income makes sense. If a company's revenue is overwhelmingly just interest and dividends, it's clearly an investment vehicle.
Right.
But what if a foreign fund just buys a bunch of aggressive growth stocks that don't pay dividend? They wouldn't have any current income coming in the door, so they'd pass the income test, but they would still be acting as a passive offshore piggy bank for their investors. How did Congress catch that scenario?
That specific blind spot is exactly why they drafted the second test, which is the asset test. A foreign corporation is a PFIC if 50% or more of the average value of its assets consist of assets that produce or are held for the production of passive income.
Oh, wow. So even if a growth stock isn't currently paying a dividend, it is an asset held for the production of passive gain.
Exactly. It catches them.
I want to pause on the word passive, though, because that can be an incredibly slippery term in finance.
Oh, for sure.
If you ask 5 different corporate accountants to define passive, you might get 5 different, highly subjective answers. Does the text provide a concrete definition to prevent companies from just reclassifying their revenue streams?
It does, and it relies strictly on the established statutory definitions used in the Subpart F rules. For PFIC purposes, passive income generally includes dividends, interest, royalties, rents, and annuities.
So it's revenue generated by capital itself, requiring no operational exertion.
Right. Furthermore, net gains from selling property that produces those types of income or gains from commodity trading, those are also classified as passive.
So if a foreign company is sitting on a giant cash reserve generating interest or holding a portfolio of equities, it's a PFIC.
Yep.
But wait, what about a commercial bank? I mean, a legitimate bank's entire operational model involves taking in cash, holding assets, and generating interest. Are all foreign banks and insurance companies suddenly reclassified as illegal offshore tax dodges?
No. The authors of the legislation anticipated that exact collateral damage. The text highlights specific statutory carve-outs.
Okay, good.
Bona fide banks and insurance companies are exempt from being classified as PFICs, provided they are actively conducting that business and are regulated as such in their home countries.
So their income mathematically looks passive, like interest and premiums, but the law recognizes it is derived from an active operational trade.
Precisely. That prevents the law from accidentally penalizing a legitimate German commercial bank just because its inventory happens to be money.
Okay, but what about corporate structures? Let's say I have a foreign holding company and all it does is own 100% of the shares of a manufacturing plant in France.
Okay.
The holding company itself has no operations, it just receives passive dividend checks from the manufacturing plant. Does the holding company fail the test and become a PFIC?
It does not, thanks to a vital mechanism called the look-through rule.
The look through rule.
Yeah. If a foreign corporation owns at least 25% by value of the stock of another corporation, the U.S. tax code essentially makes the holding company transparent.
Oh, I see.
It looks through the corporate shell and treats the holding company as if it directly holds its proportionate share of the subsidiary's actual active assets and directly earns its proportionate share of the subsidiary's active income.
Ah, so the active machines on the factory floor in France and the active revenue from selling those manufactured goods flow directly up the chain to the holding company's ledger.
Right. It prevents active, multi-tiered multinational businesses from getting caught in the crossfire just because they utilize holding companies for local legal compliance.
And that 25% threshold is key there, right? It implies a substantial operational stake, not just a passive portfolio holding of 1 or 2%.
Exactly. The legislation is laser-focused on actual passive investment vehicles, not active foreign enterprises. But if a foreign entity does meet either the 75% income test or the 50% asset test, and it cannot utilize those operational carve-outs, well, the hammer comes down.
And here's where it gets really interesting, because once a company is labeled a PFIC, the government has to figure out a way to retroactively take back the economic benefit of the deferral you've been enjoying.
Right.
You've had your money offshore, compounding tax-free for a decade. How does the IRS make themselves whole?
They introduce what is arguably one of the most mechanically punishing default tax systems in the entire U.S. code. Yeah. This applies to a standard PFIC, which in the tax world is often called a non-QEF. The government's enforcement mechanism targets something called excess distributions.
Excess distributions. So they're targeting the exact moment the investor actually realizes the deferred value, either by completely cashing out their position or taking a massive special dividend payout.
Yes. An excess distribution happens when you sell your PFIC stock and realize a gain, or when the PFIC pays you a dividend in the current year that is significantly larger than its historical baseline.
How much larger?
The specific statutory math defines an excess distribution as any current year payout that exceeds 125% of the average distributions you received over the previous 3 years.
Why 125%? Like, why that specific number?
Because they had to differentiate between a normal routine dividend payout, which is fine, and a fund trying to dump years of accumulated untaxed growth into an investor's lap all at once.
Ah, okay.
The 125% threshold gives the fund a 25% buffer for normal growth or annual variance, but anything above that triggers the alarm.
And when that alarm sounds, it triggers the throwback penalty. Walk me through the mechanics of how this throwback actually calculates the tax owed.
When you have an excess distribution, the IRS does not simply tax you on that massive gain in the current year. They take that gain and they mechanically spread it evenly across your entire holding period of the stock, assigning a flat pro rata slice to each day you owned it.
Okay, let's run a hypothetical.
Sure.
Let's say I held a PFIC for 10 years. It accumulated a massive amount of deferred growth, and I finally sell it, triggering a $100,000 gain.
Okay.
They take that $100,000, divide it by 10, and assign $10,000 to the current year and $10,000 to each of the previous 9 years I held the asset.
That is the exact mechanism. And for the slices of gain allocated to all those prior years, you do not pay tax at whatever your personal actual tax bracket was back then.
Oh, boy.
The law dictates that those prior year slices are taxed at the highest statutory rate that existed for that specific year for any taxpayer.
Wait, let me push back on the reality of that. So let's say 7 years ago, I was just starting out. I was in a low-income bracket, maybe effectively paying 10 or 15% in taxes.
Right.
If this throwback rule allocates a slice of my current gain to that specific year, I get hit with the absolute highest possible marginal rate on the books, say 39 or 50%, whatever the max was in that era, regardless of my actual financial situation at the time.
That is the mechanical reality.
That's brutal.
The government assumes the absolute worst case scenario. But the math gets even tighter. You don't just pay that highest statutory tax rate, you also have to pay a compounding interest charge on that tax amount, running all the way from the original due date of that prior year's tax return.
They treat it as if you owed them the absolute maximum tax 7 years ago, you failed to pay it, and now you owe nearly a decade of compounding interest on this phantom debt.
Exactly. And to truly lock the door on this penalty, the text explicitly dictates that this throwback tax and the associated interest cannot be offset by current year losses or net operating losses, known as NOLs.
So even if my primary domestic business suffered a catastrophic failure this year, and I have millions in legitimate operating losses that would normally wipe out my tax liability, I still have to write a check to the IRS for the PFIC penalty.
Yes. The PFIC default tax exists in a completely isolated, inescapable vacuum. It is entirely walled off from your other financial realities.
Wow. It is the government aggressively enforcing tax neutrality. I mean, they are making sure the math mathematically wipes out any benefit of hiding offshore.
Right.
By combining the highest marginal rate with compounding interest and denying any loss offsets, they just guarantee that deferral is a losing strategy.
If we connect this to the bigger picture, the sheer severity of that default rule was highly intentional. The default penalty is so terrifying that it forced investors and foreign funds to beg for an alternative.
Which brings us to the carrot.
Exactly. Congress, anticipating this friction, offered a way out, a carrot to go with the legislative stick. But they only offered it if the offshore fund agreed to integrate into the American tax system.
So if the default penalty is designed to be inescapable, there has to be a pressure valve. Congress usually leaves a compliance route. Did they offer these funds a way to opt into the U.S. system voluntarily?
They did. It's called the Qualified Electing Fund, or QEF. If a U.S. investor and the foreign fund both agree to make this election, they completely bypass the compounding interest charges and those devastating throwback rules.
But the government isn't just handing out free passes, right? What is the structural compromise required to get QEF status?
The compromise is the total abandonment of deferral. Instead of waiting years for a distribution, the U.S. investor agrees to pay tax currently every single year on their pro rata share of the fund's earnings.
Even if they don't get a payout.
Right, regardless of whether they actually receive a cash dividend from the fund that year.
So think of it like a toll road. The QEF is choosing to pay a small toll booth fee every few miles as you drive.
Yes, exactly.
The default non-QEF route is blowing past every toll booth for 10 years and eventually getting pulled over and handed a massive ticket with years of accumulated maximum penalties.
The toll booth metaphor captures the dynamic perfectly. But to make the QEF election work, the foreign fund has to actively cooperate, which creates a massive administrative burden.
If I can imagine.
The foreign fund has to calculate its internal earnings according to strict U.S. tax accounting principles, which is, no small feat for an entity operating in Switzerland or the Cayman Islands. Furthermore, they must separate their earnings into ordinary income and net capital gain and report that granular data to the U.S. investor.
Why would a foreign fund go through the massive legal and accounting headache of calculating their books based on the U.S. tax code?
Because American capital is too lucrative to ignore. If they want U.S. investors, they have to provide the QEF reporting so the U.S. investor can accurately report ordinary income and capital gains on their 1040s.
Which completely neutralizes the offshore advantage and levels the playing field with domestic mutual funds.
Right.
But wait, what if I make the QEF election, meaning I'm legally obligated to pay tax this year, but the foreign fund decides to reinvest all its cash into new assets instead of paying out a dividend?
Then you have phantom income.
Exactly. I owe the IRS hard cash on money I haven't actually received.
Well, the authors of the legislation anticipated the cash flow problems of phantom income. There is a fascinating pressure valve built into the QEF rules themselves. Investors can elect to defer the payment of this current tax liability if the fund doesn't actually distribute the cash.
Wait, I can defer the QEF tax. Doesn't that defeat the entire purpose of the 1986 reform?
Not quite. You can defer paying the actual tax liability, but you have to sign an agreement to pay an interest charge on that deferred tax amount when you finally settle the bill.
Ah, I see.
So you avoid the catastrophic highest bracket throwback penalty to default system, but you still mathematically compensate the U.S. Treasury for the time value of money.
Incredible. They thought of every single angle to ensure that time value of money always accrues to the Treasury. So with all these complex regulatory frameworks overlapping, Subpart F rules for CFCs still exist alongside these new PFIC and QEF rules. What happens if a corporate structure triggers multiple tax traps simultaneously?
This requires careful statutory coordination to avoid double jeopardy. The source text outlines explicit rules for this hierarchy.
Okay.
If a foreign company is somehow classified as both a PFIC, where the investor made a QEF election, and a controlled foreign corporation under the old Subpart F rules, well, the Subpart F rules take absolute priority.
So Subpart F eats first.
Exactly. The Subpart F inclusion comes first.
Hmm.
The QEF rules then only step in to pick up any remaining earnings that somehow slip through the Subpart F net. The fundamental principle organizing the code here is that a taxpayer should not be taxed twice on the exact same dollar of corporate income.
That brings up a very practical accounting question, actually.
Sure.
If I opt into a QEF and I'm paying tax every year on my share of the earnings, even if I haven't received a dime in actual cash,
Okay.
what happens 5 years down the line when the fund finally liquidates an asset and hands me a massive cash distribution? Does the IRS try to tax me again?
No. And this is where the mechanism of basis adjustments is utilized. Think of your basis like a prepaid tab at a restaurant. When you pay tax currently on QEF earnings you haven't received yet, you increase your basis in the stock. You're adding money to your prepaid tab with the IRS.
I see. I'm keeping a running ledger proving I have already settled the tax burden for this specific amount of capital.
And then, when you finally receive the actual cash distribution down the road, it comes out tax-free up to the total amount you have on your prepaid tab. As you take that tax-free cash out, you decrease your basis accordingly. It perfectly balances the accounting ledger over the lifetime of the investment.
It's incredibly elegant in a very dense administrative sort of way. I also noticed the source text outlines some specific grace periods, startup and transition rules.
Yes, Congress recognized the reality of corporate life cycles. Sometimes a fully active business technically looks passive for a short time on paper.
Like when?
Well, for instance, in a manufacturing company's startup year, they might have raised a massive amount of venture capital and are sitting on a ton of cash earning passive interest in a bank account before they actually finish building their factory.
Or a mature company might sell off its primary active division and temporarily hold the cash proceeds while transitioning to buy a new active business.
Exactly. The law provides specific, temporary one-year grace periods, so these companies aren't accidentally penalized and labeled PFICs just for holding cash during these transitional phases.
So they were trying to use a scalpel rather than just burning down the whole forest to catch one mouse. They wanted to kill the specific deferral loophole, not smother legitimate multinational commerce.
They successfully rewired the structural incentives of global investing for U.S. citizens, demanding tax neutrality across borders.
So what does this all mean for you? Well, every time you read a headline about a quote-unquote tax loophole, you have to understand there's a sprawling, incredibly dense labyrinth of regulations being built right now by very smart people to seal it shut. We started with Congress watching offshore funds use a simple 50% ownership rule to bleed revenue. Their response was to tear down the ownership test entirely, replace it with a definition based strictly on passive assets and income, and back it up with a mathematically brutal throwback tax.
And in sealing that loophole shut so aggressively, they created a landscape that is remarkably complex, which leaves us with a final, somewhat provocative thought based on how broadly these rules were written.
Let's hear it.
Because the PFIC definition relies entirely on those 75% income and 50% asset tests and completely ignores any U.S. ownership thresholds, it raises a massive issue for the modern era.
How so?
Well, could an everyday U.S. investor accidentally trigger these incredibly punitive default penalties just by downloading a retail trading app and buying a few shares of a random foreign software startup? Or by buying into a local European mutual fund that happens to hold a lot of passive cash?
Oh, wow. Because the 50% bouncer is gone. Everyone, regardless of how small their stake is subject to the exact same test.
Exactly. The law was originally designed in 1986 to catch tax-dodging billionaires and highly sophisticated offshore syndicates. But because the net they cast is so incredibly broad, it might just be an invisible minefield for the average person today venturing outside their home borders to build a portfolio.
It brings us right back to the beginning. It really is an international cat and mouse game, but the labyrinth Congress built is so vast you might wander into it without even realizing you're playing. Thanks for joining us on this deep dive. We'll see you next time.